Okay, first of all, we'll start with the valid break of structure, then we go to change of character. So by the end, we'll go through analysis. But within the middle of this video, we'll go through liquidity. I'm going to explain to you guys what liquidity is, how many types of liquidity we have, and how you can use liquidity advantage. I've noticed that I've not really explained to you guys how liquidity works. Let me accept this person in. So as I was saying, I've noticed that I've not really taught you guys and explained to you guys well enough how liquidity works. So I'm going to be taking you through that as well in the middle of this video, right? But then by the end, we are going to do analysis and see what we are forecasting for the upcoming week. So to refresh our minds, we talked about break of structure, right? I know everybody here must know about the break of structure already. What is a valid break of structure? Why is it a valid break of structure? And what is the concepts behind it being a valid break of structure, right? I've taught you guys all of that. Now let me refresh your minds. So we have this here, right? We normally annotate this as a break of structure. I taught you guys this already. This is a BOS, break of structure, right? A BOS, that is a break of structure. So the reason why this is a break of structure is because it took out liquidity, right, in form of an inducement under this low. So now I told you guys that this is how a break of structure looks like, and the psychology behind it is simple. The market pushed up, right? Buyers were looking to buy at this zone here. Buyers are looking to buy at the first demand zone here. So now when the market violates this first demand zone, it now has the necessary liquidity to go ahead and take out this first high. Now has the momentum to push above this first high. So whenever it pushes above this first high after taking out a valid low, now for there we get a break of structure, right? That's where we get our break of structure. So the first pullback is not a break of structure. When the market closes above this, that's not a break of structure. Why? Because the market has not yet taken the liquidity. SMC is a liquidity based strategy. Now, that's one of the things we talked about, right? That's how a valid break of structure is. So we will need this very pattern to repeat here for the next valid break of structure. For example, right, this is what I mean. We need this, and we have our valid break of structure. So since now we know that, since we know that for the next valid break of structure to occur, we need this very formation here at this zone. So first of all, what we need to do is we first mark out our inducement. When the break of structure is still to continue, right? Like that was just the first break of structure. So since we know that for another break of structure to be valid, this pattern here will need to repeat ahead. So when we have this pullback now, we just need to mark it out as our inducement, right? And now we can start looking to buy maybe somewhere from a demand zone down here. You can start looking to buy from a demand zone down here. Of course, we know that the market will not always come down right here. The market might just come and sweep and go up. So we have already talked about entry types that you can use in that case. And we also know that once the market takes out your inducement, it can likely just reverse at any random point without tapping into any POI. So we have also talked about internal structure, right? For example, you see that the market has taken out your inducement. The market was creating a minor zones like this, taking them out, then going out, and all of a sudden you see that after market has taken out your inducement, now market started moving. Sorry, I don't know why that thing doesn't want to go from that place. Market started moving up like this, and then market start moving up like this, right? So it creates an internal inducement here, then takes it out. You can look for a buy at the demand zone somewhere around here to target normally the high, right? The high where the next break of structure is. So this internal structure can play alongside through as well when the market has already taken out our inducement. Now, what is another case scenario here, right? What is the another case scenario here that we have not yet talked about? Sorry, just give me a moment. Let me. One of my computers is not connected. I'm using multiple screens. Okay. So as I was saying, right, there are other scenarios here. Now, which of those scenario is we let's say we also have a market that is pushing up right like this, right? You see that no, the market is somewhere, the market was creating higher highs on the lower time frame. We already know that this is our external structure, right? The external structure is bullish, but somewhere you see that in your smaller time frame, the market has started creating lower highs, lower highs, lower lows, lower highs, lower lows. You know that they swing the microstructure, the pullback of the micro phase has already started. If the market starts creating something like this after the market was bullish, you see that the market start creating something like this, you know that the swing structure has switched. That means this internal structure has switched from being bullish to being bearish. So this can also provide you some simple and short-term trades which you can take, right? Some simple and short-term trades which you can also take here and sell. Your target might be somewhere around this inducement, but I recommend that you target just these internal breaks of structure. Of course, counter trading is low probability, right? It will not offer you the majority of the wins that you wanted, but it will be better than somebody that doesn't have trades, right? If you apply good risk management, this will work out for you very well. So So I'm sure now that we have talked about break of structure, internal structures, and yeah, inducements, right? So let's go over to the next thing now. After your break of structure, you need to know when the market is reversing. So the last class we talked about two types of reversals, right? Two types of change of characters. We have two types of change of characters. The first one is a normal change of characters. What do I mean by a normal change of characters, right? We're taking a scenario whereby the market doesn't tap into any higher time frame POI, right? Let's say the market is moving up like this. How do we identify our change of characters, right? Now we have a valid break of structure here that has taken out inducement. So we need first the first low inducement. Bear with me as I amend this last person. So, so we need an inducement, right? Of structure has already been validated here, but we need this inducement for the next change of characters I'm going to be teaching you. This is the first type of change of characters. So we need the first low to be taken out, then our strong low, which in this case, is this low, right? It needs to be taken out. So this is where our change of characters is. If you look at this structure very well, that is that is where our change of characters is. This is not our change of character. This is our level of inducement. So we have this change of characters occurs when the market has been moving up, creating inducements, taking it out, and creating valid break of structure. This is a type 1 change of characters I taught you guys. So after this change of character occurs, what are we looking for? Definitely, we are looking for some sort of inducement to be taken out, and then we can sell. Sorry about that. It takes some time to fix that. Okay. So now we need to know that I already talked with you guys on this concept of inducement, right? You need to know that this market is always looking for somebody to screw. The market is always looking for somebody to screw over. That's why you see that when you do something, a small mistake, you have lost money. So now this is our normal change of character. So how do we utilize this normal change of characters to our advantage? Let me just label that. That's a chalk. So how do we utilize this normal change of characters to our advantage, right? We need to wait for an inducement, a zone that people that will be trying to sell off from, which will be this zone here. That's the zone where people will be trying to sell off from. So we need for the market to violate this zone, then we can look to sell off our external zone or simply just sell off our order flow in this case, which is our last pullback to the upside, which was this pullback, right? So that is how our first change of characters is. This one is an inducement. That is a trap. You don't need to look at it here. When the market is coming up, you need to be very careful and avoid this. So this is our first change of character. So let's go now to our second change of characters. Let's say we have a zone. We have a zone, right? We have a supply zone. Yes, let's use a supply zone in this case. And the market pushing up like this, taking out inducement, pushing up like this, taps into this zone. Obviously, our last break of structure to the upside, this was our inducement here, right? And our last break of structure to the upside was this zone. So in this case, you will presume that this is your strong low here. But now the exceptions to this previous one is when the market taps into your higher time frame POI, the first low that is taken out is where your change of characters is. So you see that this one is different from the other module that I showed you. This is your change of characters here. This is this exception are this exception is only when the market is coming from a higher time frame POI, right? Otherwise, if the market is not coming from a higher time frame POI, you use this first module here. So for some people, right, for some people, when they see this, they what they normally do is they don't want to just wait for an inducement, because normally when this happens, this is what they are supposed to do, right? You wait for inducement to form, and you can sell off the extreme here. This is how the market you are supposed to do. But normally, what this happens is some people don't want to risk it at this point, right? Because some people they might still be confused with the previous change of character. So what they normally do, or what you can do to better improve your chances, is wait for the market to take out an inducement, then sell. Then once it sells, now give another change of gives another inducement. Then you can look for your continuation to sell, right? Because by now the market would have shown that the market is actually going down. Sorry, I don't know. The screen seems to be too small for me to manage. So by now the market would have shown that it is really intending to go down. But some people just want sniper entry from the top. They don't want to miss anything. So they prefer to go for this first one. But the second one will work better and will reduce the risk you are exposing yourself to. So any question? Any question? I don't know. Something has happened. Any question? Yes. The first change of characters. When you go into the market is not always coming from the market might not be coming from a higher time frame point of interest. The market might just be moving up, right? Let's say the market was just moving up. I don't know where these things keeps coming from. Now I'm filling up my screen. Yes, yes, it's just moving up. It's just creating break of structures to the outside, break of structures to the outside, and this is where the change of character comes from. Now, this second change of characters now is if the market was moving up, it encountered yeah, a supply zone. The supply zone. So that's it. That's it, right? So I don't think there's anything else. So let's go into liquidity concepts, right? So we are going to just give me time. Let me clear this off. Okay, c'est bon. So liquidity concept. So we are going to look at we are going to look at numerous types of liquidity concept. I'm going to try and cover majority of them. I've not taught this before. I don't think I've taught you guys this before, but I've given you guys an idea of what liquidity concepts are. So first of all, we have equal highs. We have equal highs, right? So how does the market perceive equal highs? Something of this sort. Let's say, looking at this, right, you might see that we have relative. Let's see, let me look for a better example. Since it's the first class, it's good that you guys should be, I should give you guys the best example. Okay, so if you look at this, right, if you look at this zone here, you see that this market created some sort of highs here. Let me illustrate this first. If you see that the market creates something like this, and the market is coming back up. So the market has created some sort of highs like this, which are equal. So normally what happens in this case is the market tends to seek out these highs and destroy them before pushing down. It will just be maybe one violent move or just a candle that pushes off and doesn't close with a candle body, right, above this one and continues up. So that happens a lot in the market. So that is either equal highs or relative equal highs. So how does this happen, right? You see some sort after the market has created something like this, the market just comes up and does something like this and continues to a downside. So this is one type of liquidity you should look for. So if you see here, that's almost the very thing that happened here. It created this highs here, then break through the highs, made as if you wanted to go, then did a violent drop. If you see here, we have the very things, right, the very thing from these two highs. This high like this, they took out this liquidity above these highs. So that is the first type of liquidity and the way you can look at it, right? Then we also have equal lows, right? Basically the equal lows are just the example of this. Now, let me show you what we mean by equal highs, relative equal lows, and all the like. If you look at an example like this, let's say we have something like this, right? This the M pattern that you get many people say I trade the M pattern. Now, this will be equal highs. I know that many people don't understand the difference between relative equal highs and relative equal highs and a high that the liquidity has been taken off, because one looks like a W, one looks like some some the other looks just the same. So now this is a relative equal high. Sorry, this is a equal highs, right? Where this high here it's just the same as this one. So there is liquidity above here. People that are trading support and resistance, they're selling when the market touches this line. So this is what we know that those people are what they are being considered as liquidity in this case. So we have the opposite of this, which are equal lows. Now, after this, right, we have another very interesting form of liquidity, which looks almost similar to this one, right? We have this one which the leg is shorter, one which the leg is shorter than the previous. This is what is being referred to as relative equal lows. Something like this, right? It's inclined. This is these are relative equal highs here, and we have the opposite of this. Now, what would differentiate between this zone, even though these are not equal, right? These are considered to be a zone of high liquidity. So now, if you see something of this sort, please just give me a minute. I was recording, and the recording just is just about to stop. I will need to continue it.